Welcome to Pro Webcast News, where we bring you daily industry updates. Today is Tuesday, January 5th, and you're watching the Afternoon Update with Paul Wilson. Today's news is sponsored by Tucker Advisory Group, teaching both clients and financial advisors powerful, safe money strategies. For more information, please visit tuckeradvisorygroup.com. Now for today's headlines. Pending sales of previously owned U.S. homes declined by more than expected in November, according to a survey released today by the National Association of Realtors, or NAR. The association's pending home sales index, based on contracts signed during November, fell 16% to 96.0, the first decline in 9 months. Despite the drop, the index remained 15.5% higher than the same period last year. Home sales have recently been aided by an $8,000 tax credit for first-time buyers, which has since been extended to the middle of this year. According to NAR chief economist Lawrence Yun, quote, "The fact that pending home sales are comfortably above year-ago levels shows the market has gained sufficient momentum on its own. We expect another surge in the spring as more homebuyers take advantage of affordable housing conditions before the tax credit expires," unquote. In healthcare news, U.S. healthcare spending increased at the lowest rate on record in 2008, yet still cost $2.3 trillion, according to a recent report by the Centers for Medicare and Medicaid Services, or CMS. The report found that U.S. healthcare spending rose 4.4% in 2008, the slowest growth rate in nearly half a century, and lower than the 6% increase of the previous year. In addition, the CMS found that healthcare spending accounted for almost 36% of federal spending in 2008, up from 28% the year before. The $2.3 trillion averages out to $7,681 per person. Finally, despite the decreased growth rate, healthcare spending still accounted for 16.2% of U.S. gross domestic product in 2008, up from 15.9% in 2007. In employment news, the number of U.S. metropolitan areas with unemployment rates higher than 15% rose in November, despite the largest one-month decrease in the national rate in more than 3 years, according to data from the Labor Department. 17 of 372 metro areas surveyed experienced jobless rates of at least 15% in November, up from 15% in October. Overall, unemployment improved nationally to a seasonally adjusted 10% for the month, from the 26-year high of 10.2% suffered in October. 3 separate areas in Michigan experienced unemployment rates of more than 15%, with Detroit enduring the highest unemployment rate for the month at 15.4%. Meanwhile, California's Inland Empire, which includes Riverside, San Bernardino, and Ontario, followed Detroit among larger metro areas with a jobless rate of 14.2%. El Centro, California, continued to hold its place as the metro area with the highest unemployment rate at 29.2%, down from an upwardly revised 31.9% in October. I'm Paul Wilson, and thanks for watching Pro Webcast News. For more in-depth news and features, visit producersweb.com.